Yes, regarding the global economy, if you look at the history during the last 10 years roughly, the global economy has been growing about 2.75%. And we're now at that level roughly at about 2.75%. And of course that's too slow. We would prefer to see 3 or even 4% going forward. But I think at this level the trend will be upwards rather than downwards because we've had a few difficult years, particularly in emerging markets. And I believe now with the U.S. economy recovering and also Europe on a mend, we believe that the global growth will probably be a little better next year. Actually, this is the worst time to pull money out because we've seen about 3 years of underperformance by emerging markets. Now we're beginning to see a recovery. In fact, in the last few months, you've seen the emerging markets index move up. And countries like Thailand, we believe, will continue to do well, will improve. China, of course, is still growing at a fairly high rate. People remember that they think of the 10% growth that we've had in 2010, and now it's 7%. They say, well, China is slowing down. But in fact, the amount of money that 7% now represents is much greater than 10% in 2010 because the base of the economy is growing. I can't think of anyone now that will be underperforming because if you look at the major emerging market economies, Brazil is in the low point and probably now will start a recovery. Russia is in the same condition. India is doing well and will continue to do well. China is still growing at a good rate, and we believe they will solve the problems they've had with the capital markets, with the stock market. So I can't think of any place where you would not want to be in emerging markets at this time.
So because of the factors of the commodity price that still quite low, this will be the major concern on.
Well, that's another very good point because if you look at commodities, they are at the low point and the chances are better that they will be coming up rather than going down further. So countries that rely on commodities will probably have a brighter prospect going forward. I think it depends on the state of the U.S. economy and the state of what's happening globally. Because the Fed now is looking at what is happening in Europe, what is happening in Japan, what's happening in China. And they don't want to be out of sync because while those other economies are actually adding liquidity to their economies, the U.S. is planning to decrease liquidity. So this will not come together, and it will be a problem for the U.S. if they move too fast on raising rates. So my suspicion is that they will wait till maybe the end of the year, beginning of next year, and if they do, and this is a big if they do raise rates, it will be by a very small amount, just to sort of preempt any inflation expectations. But you must remember, the big dilemma facing the central bank is that there is no inflation. We are actually heading into a deflationary mode. So this is a big challenge for them. That's right, it doesn't seem to be there. And I think one of the reasons why is because of the internet and what's happening to smartphones. The smartphone revolution is creating a situation along with the internet where productivity is increasing rapidly and where prices are falling. I don't think other central banks will follow because they are trying to revive their economies. So they will tend to continue on the path of injecting more liquidity into their systems and lowering rates rather than raising rates. So it's a real problem for the globe. And for investors, of course, the uncertainty is the biggest problem because, as you know, markets don't want to move unless there's some degree of certainty at the policy level.